In today's video, we're going to do an analysis of some factors that will help tell us where we are in the market cycle and around when the stock market might crash. As always, if you want to learn more about the stock market, personal finance and entrepreneurship, then consider subscribing to Cooper Academy, and to be more on the ball, hit that notification icon. So one of the most important measurements that we have to look at when figuring out if the market is overpriced or a bubble type market is the Shiller P ratio. This is a measurement recommended by Warren Buffett's mentor, Ben Graham, and it tells us the return we'll get on the overall market based on the current price levels. So currently the Shiller P ratio is 34.242. This means that the US market is priced at a 2.92% overall return. It doesn't take a genius to work out that that's pretty low. But when it comes to money, we have to put it somewhere. So we must compare our overall stock market return with the returns we can get in other places where we put our money. One option is just to leave it in cash, where you will get a 0% return. The other option is the bond market. So the 10-year treasury note currently has a yield of 2.8%. And this is considered a zero risk investment because it is backed by the government. They can always print more money to pay it back. So if we compare these returns, we can see that the stock market return is just higher than the bond market. But overall, that's some pretty similar returns for two different investments with very different risk profiles. The 10-year treasury being pretty much zero risk and the stock market pretty high risk. So that's one of the measurements we can do. Compare the different returns where we can put our money. Remember, there are advantages and disadvantages to the different types of investments. Okay, now I want to delve into some of the measurements that Ray Dalio uses when figuring out when the market will crash. Why Ray Dalio? Because he's known as the market timing expert, so to speak. That's his gig. So one measurement that Dalio uses is the unemployment rate. This is a very important factor to look into when seeing where we are in the market cycle. Whenever the unemployment rate gets low, that is a sign that we are nearing the end of a bull cycle. So let's look at the history of previous market crashes and what the unemployment rate was doing when they occurred. So I'll take you back to the stock market crash in January 1973. The unemployment rate had bottomed at 4.9%. Then the Black Monday crash in 1987, the unemployment rate was close to the bottom at 6%. Then the dot-com bubble in March 2000, the unemployment rate was at the bottom of the cycle at 4%. Lastly, the housing bubble crash in 2007, the unemployment rate was 4.7%. So as you can see, there's a noticeable relationship between a stock market crash and a low unemployment rate. This is because when unemployment gets low, it means we can't stimulate the economy much more with increased workers, meaning things will slow down. So currently we're at an unemployment rate of 4.1%. How low does it have to go? That is one thing that we just don't exactly know, but the thinking is that it will bottom out in the next couple of years. Another very important measurement that Dalio loves is the 10-year treasury minus the 2-year treasury. If this number is zero or in the negatives, it means people will be more inclined to put money in for shorter periods. They don't want to put their money in for long because they get less of a yield. So again, this slows down the economy. Let's look at the relationship between this factor and historical market crashes. So unlike the rest of the crashes, in 1987 the difference was higher than normal at 1.3. In the March 2000 crash it was low at a negative 0.47, and in the dot-com bubble crash it was low at 0.54. So generally speaking, the lower it gets, the higher the chance we have at the stock market crashing. But again, there is not a set number that it needs to get to. As you can see from previous market crashes, the numbers were different. That's why no one can exactly predict when the stock market will crash. It's just not possible. But what we can do is look at certain measurements that tell us around when the stock market might crash. And from these certain measurements that I've just shown you, we can say that there is a good chance that the market will crash in the next couple of years. Ray Dalio said that there is around a 70% chance that the market will crash before the next elections in 2020. So those are some of the main factors that I am looking at when figuring out where we are in the market cycle. It appears we are getting towards the end of a bull market run. We can still play in the stock market, but just play a little closer towards the exit doors. In my next video, I'm going to show you guys what the best investing billionaires are saying in the current market, and I'll also show you how they are preparing their portfolios. Okay, as always, I hope this video was helpful. If it was, please leave a like to support the channel. Oh, also, I'll leave some links in the description to show you where to access the data that I've used in this video. Thanks guys, and have a great rest of the day.